Edward Brown, host of The Best of Investing, here to remind you to tune in this week on Saturday at 8 p.m. Our guest is going to be Zachary Beach. You're not going to want to miss this show. That's The Best of Investing on Saturday at 8 p.m. Welcome. You're listening to The Best of Investing. I'm your host, Edward Brown. Our phone number is 888-912-1190. Use that number to answer the trivia questions for a 5-pack tanning certificate given away during this show. That certificate's not sponsored by the radio station, but by Tan Bella Tanning Salon with 2 locations in San Francisco and 1 in Marin. Today's trivia theme is miscellaneous trivia. We do have a special guest today, Troy Eckard of Eckard Enterprises LLC. The title of this show or this episode is How to Win as a Contrarian Investor. This ought to be interesting. I'm going to read a little bio here about Troy. He, for 4 decades of oil and gas expertise to lead Eckard Enterprises LLC in securing significant investments for high net worth individuals. Since 2019, his company has placed $850 million in capital across over 90 portfolios, acquiring mineral rights, working interests, and the second largest natural gas pipeline in the Gulf of Mexico. Today, Eckard manages over 7,000 wells and has distributed $110 million in free cash flow to investors within the last 4 years alone. Troy, welcome to The Best of Investing.
Thank you so much for having me on board. I really appreciate it. And of course, when you hear those numbers and statistics, you think, well, what does that really all mean in normal language? Because most people have no clue what that all means, right?
True. I mean, we all know what raising $850 million from capital from investors. Yeah. We know what that means. So let's start off with what is your investing philosophy?
For me, it's you always want to buy the house with the longest grass, and what that means is that I'm a contrarian thinker. If you can identify value, then so can everybody else. If you can take the normal path to get from point A to point B, then so can everyone else. What you're really looking for is the arbitrage, the opportunity that's right in front of you that most people don't slow down to take advantage of, because you always make your money on the buy side. So you have to have an absolute contrarian opinion to find the true value.
I like that. So you've placed $850 million across 90 portfolios. So how does that work? Do you raise a certain amount for a specific well and then close it off and do another one? How do you do your portfolios?
Yeah, really what we do is we aggregate fractional interest of mineral rights in key areas we believe the exploration and the revenue will generate double-digit returns. We incrementally put different mineral tracts from different oil and gas companies into a single bundle. We call it a portfolio. And then a participating investor who's qualified can participate in that portfolio with direct ownership. But you get a percentage across all the mineral tracts, all the oil companies, all the wells, so that way you're well diversified and your risk is extremely low. So we basically have a strategy of AML, aggregation, maturation, and liquidation, and the aggregation part is really the part of our success. We know how to take undervalued assets, put them in a bundle, and invite high net worth investors to participate.
And if I'm not mistaken, this type of investment produces some potentially some tax benefits for like depletion allowance?
Yeah, everything involving oil and gas, because you're depleting a reservoir that has a finite amount in it. The IRS gives you the ability to take 15% of your gross income and not pay taxes on it. So that's the first benefit, is I'm only paying tax on 85% of my income. The other benefit, depending on which asset class in the oil and gas space you're participating in, you get huge or substantial first-year tax deductions when you actually participate in drilling a well. It looks like with President Trump taking office, if he goes back to what he did in 2017, basically 100% of your investment in a domestic exploration investment will be 100% deductible in the first year. That is a massive tax savings to high-income investors. Yeah,
it definitely is. Tell you what, we're going to go to our first commercial break. Just as a reminder, I'm going to ask a trivia question. If you know the answer, Troy, don't answer it yet. We're going to go to commercial break. We'll see if the audience knows it. And then we'll let you answer when we come back. This one you have to actually kind of think about because it's more than one answer. How many pairs of U.S. presidents have had the same last name? That's our trivia question. Call 888-912-1190. The first caller with the correct answer wins that tanning certificate, which, by the way, is worth over $100. Nice little certificate that Tambella Tanning Salon is giving away. Again, here's the trivia question. How many pairs of U.S. presidents have had the same last name? All right, stay with us. You are listening to The Best of Investing. Don't touch that dial. We're going to be right back. Welcome back to The Best of Investing. Again, I'm Edward Brown, your host, along with my special guest, Troy Eckard. First trivia question. How many pairs of U.S. presidents have had the same last name? And let's see if you can name them. Troy, go ahead.
I'm going to say I'm pretty much not a specialist in that. I'd say there's going to be Adams. And I believe, I think that's about the only ones I can come up with myself. I'm not that good on the presidents, to be honest.
Okay, so you have John Adams and then his son, John Quincy Adams.
Correct.
You had William Henry Harrison, who he'd only had a month in office because he died of pneumonia. And I think his grandson is Benjamin Harrison. Then you had George H.W. Bush.
And Bush,
obviously. Then you had Teddy and Franklin Roosevelt, and I think they were just like third cousins or something. And then Andrew and Lyndon Johnson. I don't know if there was any. There might have been some kind of relationship. So the answer is 5, is what we came up with.
All right. Very nice trivia.
Yeah, you like that one, huh? I noticed when I was reading this that you have some natural gas pipelines. We said Gulf of Mexico, maybe change to the Gulf of America. Is that running through like Louisiana and?
Yeah, so basically back in the 1930s and 40s, everybody that wanted to drill in the Gulf of Mexico had to get gas from the production platforms to shore, but no one could afford to take the risk because you didn't know if the well was going to be good. So over the last 100 years, all this infrastructure of pipelines from out in the open water are connected at platforms. They lay on the bottom of the ocean floor and they come up on the beachhead in Louisiana, Texas, Mississippi. And so we've acquired about 1,600 miles of pipeline, and that pipeline company's been around for quite a while. And we service big companies like Shell Oil, et cetera, who move their natural gas from the wellhead out in the ocean to the shore.
And, from what I've just, I'm quite an amateur in this, but if you're talking you're talking like natural gas where, that's like the cheapest gas and cleanest gas out there, for like heating.
Yeah, it is. Just think of every oil well as being like a 3-liter bottle of Diet Coke or Coke. You got a lot of liquid, but you have a lot of fizz and foam. So even if it's a big oil well, which is drilling with water, you're getting a lot of gas.
Okay, but by the way, you're cutting in and out, so hopefully your internet speed's working well there. So let me ask you, how do you approach your due diligence?
Well, when I look at anything, the first question I ask is the who. Who's behind it? Who put it together? Who are you? And what background, antecedents, or resume do you have to justify being an expert in that asset class? And so the who is absolutely incredible. I don't care if you have the best opportunity or asset or investment. It does not matter until I'm satisfied the who is correct. And so that's my number one criteria, is who am I dealing with? And I think the second thing is I need to see how you're making money. Now that may sound obscure, but you're always looking for incentive and motive. And I want to know, you're putting something together, you're asking investors to participate, which means you're taking on a fiduciary duty. What do you get out of this that makes you want to do that? And that's really important, the who and the why. Gotcha.
And let's see, so that's pretty good, raising $850 million since 2019. And, we saw the craziness with COVID, with oil prices dropping to like negative 34. That was a crazy time. But apparently you've distributed $110 million in free cash flow. So do you...
Actually, the numbers are outdated. We're just about to cross $1 billion. We sent out last year about $60 million. We're about $150 million distributed. And this year in 2025, we'll probably send out 75 to 100 million this year alone.
And does it, I was going to say, not that it doesn't matter, but because obviously it does matter. What price range of oil prices for the oil side of things? Do you have to work within a certain region? Like, if oil goes below $40 a barrel, you don't make money, or how does that work?
It's a great question. What you're basically saying is the threshold of economic despair,
Yeah.
which is been historically the last 3 or 4 years about $39 a barrel. Means you're kind of paying the royalty on it, you're breaking even, paying the bills. But that number has moved dramatically over the last 15 to 20 years because as labor goes up, cost
Yeah.
of fuel goes up, insurance goes up, the break even moves higher. I would say that currently we're probably at a break even between $45 and $55 a barrel, which means even if President Trump says drill baby drill, we're not going to
Yeah.
increase rigs, we're not going to drill baby drill. If we don't see oil staying at $75 to $85 a barrel, there's no monetary incentive to increase our activity. And it really does put a very hard pressure on free cash flow and profit. But the key to this is that these oil companies have been so proficient. They've been able to manage drilling much better wells, much faster, lower cost per well. And that keeps that break even low enough we can enjoy $70 to $80 barrel oil here in the US.
So when Trump left office, gas prices were pretty good, $2 a gallon.
Yep.
One was presuming that as soon as he gets in, that if drill baby drill, theoretically you have supply going up, prices at the gas pump would go down. Is that not going to be the case if oil needs to stay at the figure that you're talking about?
Yeah, I don't think that's going to happen this time. I think he's missing a couple of key components that really he's probably aware of, but the drill baby drill is a great drum to beat to get people focused back on fossil fuel. Two things that's going to happen. One, he's going to take away the subsidies on alternative energy like wind and solar. They're going to go bankrupt. All those users are going to have to go back to fossil fuel. So you have an enormous amount of fossil fuel demand coming in the next 24 months. Number two, you're going to see that with the price of oil and gas where it's at, it's going to be difficult for President Trump to maintain drill baby drill because we don't have the equipment, the manpower, or the labor. So we're pretty well maxed out as an industry.
Gotcha. Okay. Hey, tell you what, we're going to cut to our second break. This is very interesting stuff here. I like the expertise that you have. Okay. Second trivia question. How many ghosts visit Ebenezer Scrooge in A Christmas Carol? Call 888-912-1190. First caller with the correct answer wins that tanning certificate. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing one more time. I'm Edward Brown, your host, along with my special guest, Troy Eckard. Second trivia question. How many ghosts visit Ebenezer Scrooge in A Christmas Carol?
3.
Troy?
3.
Actually, 4. You forgot Jacob Marley. It wasn't really a trick question, but it was sort of a trick question.
Well, you got me.
All right. So Troy Eckard of Eckard in Enterprises. I'm assuming that you, when you have these portfolios, are they different LLCs that investors can invest in?
No, I run my company based on direct ownership with deeds and titles. Whether you're participating in minerals or working interest, we want you to know that it's real estate and you own it. So what we do is we offer you a purchase sale agreement with an exhibit that shows you the specific piece of real estate and mineral rights and working interest that you own. It's recorded in the courthouse. And then we've designed the only app of its kind in alternative asset space called Eckard Insights. Your deeds are loaded. You can check your production every day. It's no different than Robinhood as a mainstream investment. We've made oil and gas investing with Eckard just like buying Robinhood. You see your data every single day, 24 hours a day.
So let me ask you, this is going to get a little bit more on the sophisticated side. How much is like your average well that you're purchasing?
Well, we don't buy wells. We buy minerals or we participate in drilling. But the average horizontal well these days in the United States probably runs around $9 million to drill a single well 2 miles down vertically that goes out 2 miles horizontally. And that varies from North Dakota to West Texas to Oklahoma, but let's just call it $9 million average.
$9 million. Okay. And when you're, how much, are you raising like minimum $100,000 from each person or?
Well, what we've done is we have developed a way of creating a portfolio strategy. So our average investor has got about $600,000 invested with us.
Okay.
It's available for 1031 tax exchange. You can invest in your self-directed IRA. You can invest out of your ordinary account. But for us, what's really happened is that we've attracted about 3,000 investors over the last 5 years. We're offering about $15 to $20 million a month in mineral portfolios and about $200 million a year in drilling. And to be candid with you, we just can't keep up with the demand. I mean, we're getting our phone ringing off the hook because I think most investors have decided energy is a great counterbalance to public stocks, Bitcoin, and other types of asset class. So they've been adding energy because it pays every month, whether it's drilling a well or minerals. Every single month, 12 months a year for the next 25 to 75 years, you'll get a check from your oil and gas investments. People love cash flow. They like consistency. They like to get paid often.
So ignoring the tax benefits for just a minute, someone invests $100,000. What can they expect? Not guaranteed, obviously, but what can they expect from day one?
Well, from our track record the last 6 years, everything will start paying out distributions about 6 months after you invest in minerals, about 9 months after you invest in drilling. Our drilling programs have averaged over 30% annualized return year over year, and our minerals are averaging 13% cash on cash every single year, and that's not counting any tax deductions. This is pure cash on cash return. We are breaking our own potential economic model. We're surpassing on our drilling, surpassing on our mineral rights. It's because we work extremely hard on the expertise of knowing what to buy with what oil company, and because of that, we're really crushing our own expectations from our own financial model.
And because it's considered a depleting asset, in theory, if let's say you expect it to last, make it simple, 25 years,
Right.
would 4% be considered a return of capital then? Because eventually in 20, if it's expected 25 years, does that mean 25 years, that's it, it's run dry?
Well, say you got a big chocolate shake and you are real hot on a Saturday afternoon in July. The first 2 or 3 sips is going to be like the first 3 years of the well. It's going to taste good, feel good. You're going to get that quench. Well, we get our money back in 36 months by drilling wells. We hope to get our money back in 7 or 8 years from our minerals. But now I have a cash paid for asset that generates revenue monthly for the next 25 to 75 years. But to the chocolate shake analogy, there's only so much in that one chocolate shake.
Yeah,
so
exactly.
if I drill wells, I'm tied to that one well bore. But if I buy minerals, I own every single well, all geological depths, all wells forever, including every molecule of gas and oil. So most people buy the minerals because they want no expenses, no bills. They want to own every drop. Some people want the big tax write-offs because they're in a high income bracket. They want to drill. So a lot of our clients do both. Tax write-offs, buy minerals, they get cash from both sides, and it manages and give them the maximum tax value with the maximum return.
Gotcha. Okay. Believe it or not, we got to go to another break. This stuff goes fast, I'm telling you. Before we do, though, I do want to make a mention here for Mountain Mike's Pizza in San Rafael. Pizza, the way it ought to be. Check them out. Mountain Mike's Pizza, San Rafael. All right. Third trivia question here is, which 2 sports brands were founded due to sibling rivalry? All right. Which 2 sports brands were founded due to sibling rivalry? Call 888-912-1190. First caller with the correct answer, again, wins that tanning certificate, which is worth over $100. Also want to make a mention here for the Lakeshore Lodge. There's got to be good skiing up in Tahoe right now. Check them out, lakeshorelodge.com. All right. Stay with us. You're listening to The Best of Investing. Don't touch that dial. We are going to be right back. Welcome back to The Best of Investing. Edward Brown, along with Troy Eckard. And our third trivia question here. Let's see if Troy knows the answer to this one. Which 2 sports brands were founded due to sibling rivalry? Any idea?
I'm saying sports brand, you're probably talking something like Rydell or Nike, and I'm guessing I have no clue because I'm not a big sports fan, but I'm going to say Rydell and Nike.
Actually, Adidas and Puma. Those are Nike, Adidas. The Dassler brothers, not even familiar with them, but okay. Excuse me. Let's see here. What are the biggest mistakes you've seen investors making today?
2 things. One is they do not do any homework. They all think they're Google smart. So what they'll do is they'll listen to a pitch. They'll find out very peripheral details, and then they throw money in because they think it's like gambling with monopoly money. So they are very careless. They don't do their due diligence. And then I think the second thing is what they don't understand is the number one game to being wealthy is not to lose your principal. So if you took super good care of your decision-making up front and found excellent sponsors or experts, you would find yourself not losing money, and your wealth and your income would grow exponentially bigger.
Yeah, no, I I agree. That's to me preservation of principle because people don't realize that, and I'll just pick on the stock market just because I'm picking on the stock market. If you lose 20% one year, you got to make 25% on the remaining money just to break even.
Correct.
So it just
Well, and
depends
that,
on when you make money and yeah, good.
well, Ever, that's what I tell people. They get so excited about tax write-offs. They get excited about investing because they listen to the pitch. And I said, if you put $1 million in 10 investments, but you lost 2 or 3 because of careless investing, you may never see break even, much less get a rate of return on your money. It's a negative relationship. So
Yeah,
I say you got to do your homework up front. And there are great investments out there, but it takes time and you have to ask the questions, get the answers, and you have to be sure that you have your common sense hat on because a lot of things just don't make common sense. But people don't listen to that. I mean, today, right now, there's a massive amount of deals being funded based on what I consider to be fraudulent presentations because
yeah,
people are desperate to find out where the new deals are. Look
yeah.
for performance, looks for expertise, looks for track records, look for things that says this person's been around 10, 15, 20 years and they're still here. That's a great sign. Somebody's only been in the business for 5 years. They barely even have their ink dry on the paper starting their company. It's very nerve wracking.
Well, now, okay, so since 2019, your company has placed close to $1 billion, but you've been in the business a lot longer than that.
Yeah, I started in 1985 as a licensed broker like you did, securities. And then
Yeah,
I started my own investment firm in 1991, my first oil company in 1995. And then I aggregated a bunch of different businesses that I had in about 2011 under Eckard Enterprises. Now it's a
yeah,
family run energy business and that kind of encompasses. But I've got 40 years of experience as of this year, four
gotcha. Okay.
decades.
Um, give out your information in case people want to check you out, and also, what is your minimum investment?
Minimum investment on any investment is $25,000 per portfolio, so it's pretty low.
Yeah,
And again, for us, it's pretty simple. Look, let me just tell everyone, all your audience, very simple. You go to EckardEnterprises.com, go on that site and pull up Eckard Insights, and that's our exclusive proprietary app. You do not have to be accredited. You don't have to invest. You don't even have to give us anything other than, hey, want to look at your app and I want to find out what's going on. There are literally hundreds of videos of educational information covering almost every topic you can think of that I've spent the last 5 years developing. Because why? I want the smartest investors out there in the marketplace. I want you to be educated and informed, whether you ever invest in my company or not. I just want you to be careful, watch out for your money. There's a lot of wolves at the fence. And so we've designed that. So EckardEnterprises.com, pull up Eckard Insights, sign up for the app. You have thousands of hours worth of videos, train yourself, educate yourself, and go from there.
and what kind of liquidity is there if somebody needed their money back after 2, 3, 5 years?
No different than buying a lot in downtown San Francisco. So it's real estate. So what you'd end up doing is you buy it for the tax benefits, you buy it for the cash flow. However, in the case of our company, on our app, we built a partner to partner exchange. And we did that because we have people that die, get cancer, divorce. And so it allows any one of our partners to put their asset or portfolio on that peer-to-peer market, and other partners will buy them out. And that has been an unbelievably successful
Yeah.
tool that we've applied. And it's helped so many of our investors be able to create liquidity in cases of just needing it or cancer, health, or death, et cetera. So we're the only company, alternative asset space, that created their online market for their partners. Only one.
That's I like that. I guess it'd be kind of difficult to figure out though if something's 5 years in. What's the lasting? If someone invests 25,000 today, but 5 years later, how would the buyer decide? I mean, I know it's willing buyer, willing seller, but how would what kind of analysis would a buyer make?
Well, the way we do it, because all of our partners are only selling to other partners, we educate our clients continually on what the value is at the time of purchase,
Okay.
minus the revenue stream they've got at the time of sale. They know what the remaining reserves are, how many wells are going to be drilled, how many formations are left. We have a really, really educated, 3,000 clients. And so they'll say, hey, he paid 100,000, he's made 20% return a year. He wants to sell it for 140,000. Oh, I think that's a great deal because there's 9 more wells coming at 1 million barrels per well. I'm getting a heck of a deal. They're actually become very, very smart oil and gas investors. And that's what we do. We want you to be smart enough to figure out on your own what you want to do, what you want to pay. And it's worked out very, very well for us.
And what kind of tax reporting do you guys send?
On the mineral rights, you're going to get 12 distributions a year and a 1099. That's it. No bills, no expenses, no losses, et cetera, right? Working
Yep.
interest, we give you a tax summary like a Schedule C. It goes to your CPA and you get a 1099 for your income. This is not in a SPV. It's not in a partnership. So it makes it so clean for your accountant and your bookkeeper. And you're going to get 12 checks a year from either drilling or minerals. So people love that frequent cash flow, and it works.
Yeah, no K1, so they don't have to wait till March 15th or whatever to get the K1. That works out pretty well.
Yes,
Well,
sir.
let's see. Troy, thank you so much for joining us. I know that you've got some other stuff to do. I've got one more segment that I'll just go ahead and do solo because I know that you're gonna have to run here pretty soon. Again, give out your information one more time.
Yeah, it's Troy W. Eckard, Chairman of the Board of Eckard Enterprises in Allen, Texas, at www.eckardenterprises.com, or you can call 800-527-8895 and ask for someone of our wealth team to help you out, and we'll be glad to talk to you.
All right, audience, stay with us. You're listening to The Best of Investing. We're going to be right back with some closing comments. Don't touch that dial. Welcome back to The Best of Investing. Last time for today, I'm Edward Brown, your host. Troy had to take off, so I'm going to do this last one solo. We didn't have a trivia question, but I do want to do a couple of things here. Something's going to be kind of fun, but before we hit the fun stuff, I wanted to let the audience know that Pacific Private Money's got a new fund called Arrival. It's a kind of a limited time only right now, because once they hit a certain amount they're investing, they're going to close it off. So you may want to check them out. PacificPrivateMoney.com and ask about the Arrival Fund. Tell them you heard it on the radio show, The Best of Investing. And right now they're still paying 10%. It's a new fund, so they don't plan to change that. But you got to get in before that one closes. And then also, Pacific Private Money is also giving a special 10% rate on their other fund called the Freedom Fund. But that one's only good for 6 months. So after investing for 6 months, they're going to probably back it down to 9% or 8%, depending upon how much money you invest. So again, check them out, pacificprivatemoney.com. Tell them that you heard it on the Best of Investing radio show. So, excuse me here. Okay, so we have some fun stuff to do. First of all, here is the silly joke of the week. A guy placed an ad on a local affairs website. I have 2 tickets for Super Bowl, both box seats. I paid $2,500 for each ticket, but I didn't realize last year when I bought them that it was going to be on the same day as my wedding. I'm looking for someone to take my place. The wedding is at St. Thomas Church, Providence, at 3 p.m. Her name is Amanda. She's 5'6", about 130 pounds. She'll be the one in the white dress. Don't tell my wife I told that joke. She's not going to like that one. All right. And let's see here. Again, you want to check out pacificprivatemoney.com. By the way, they have other funds available. They have the Pacific Southwest Fund, which buys discounted mortgages. That one just pays a flat 8.5%. And again, they have their Arrival Fund, which is paying 10%, and their Freedom Fund, which ordinarily pays a lower rate, but they're having a special, a midnight special, as they say, where they're paying 10%, but for a limited time, only about 6 months, starting from the day that you invest. So you'll want to check them out at pacificprivatemoney.com. Let them know that you heard about them on the radio show, The Best of Investing. And very interesting with Troy talking about oil prices. You had the incoming President Trump saying the drill, baby, drill. And the presumption is that as soon as he does that, there's going to be so much energy out there that the prices will drop, which would relate back to the pump. But it'd be very interesting to see if Troy is accurate with regard to there's only so little a price that oil can drop to where the drillers can make a profit. So even if there's so much supply, if the price is too low, they're not going to be able to take it out of the ground because of labor and maybe other costs that get involved. So it'll be very, very interesting to watch oil prices as President Trump gets in, and then also to see what ends up happening, not only price per barrel, but how does that relate to the gas pump? Because when Trump left office, gas prices were extremely low and oil prices were low. But then, of course, we had a new president come in and inflation went way, way up, which the cost of everything went up. And so Troy might have a point here where prices can only drop so low. So hopefully President Trump will think about a way for the gas prices to go down. Maybe take away any kind of taxes, especially in California. That'll be more of a Newsom situation, but we'll see what happens there. All right, so now we're ready for our thoughts for the day. So today, a man knocked on my door and asked for a small donation toward the local swimming pool. So I gave him a glass of water. I'm such a nice guy. And people who use selfie sticks really need to have a good long look at themselves. All right, audience, tune in next week to The Best of Investing. We're going to be giving away more prizes for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long.